Discuss about the deferred tax asset, valuation allowance, when they are required, and their impact on the financial statement, and how the companies they handle this deferred tax asset and the financial statement. So let us begin it with the deferred tax asset definition. Deferred tax asset, as we already know, it is created when the taxes payable or the tax return is greater than the income tax expense. Okay, so whether it is deferred tax asset or deferred tax liability, they are not carried forward on the balance sheet at their present discounted price of the present value. Okay, so but the deferred tax asset is assessed at each balance sheet date to determine whether the sufficient taxable income is there to generate tax asset. Okay, under US GAAP, what happens, some or all of the portion of the deferred tax assets are not realizable. Okay, and those portion of the unrealizable part of the deferred tax asset is called the valuation allowance. It is basically a contra account which reduces the value of the deferred tax asset. Like when the valuation allowance reduces in value, the deferred tax asset increases, and vice versa. Okay, so when it is required by the companies, suppose a company has got a backlog of orders or some contracts which will be carried out in the future, to which will ultimately generate the taxable income. So for this, it will not the contra account or the valuation allowance is not necessary. But when the company has a cumulative losses that is carried forward over the past few years, or tax losses that is it is not carried forward actively, or any usage, then in that case the valuation allowance is required. Okay, and its impact on the financial statement will be, when the deferred tax asset increases in value, then income tax expense will reduce in value. Okay, because we already know income tax expense is equal to tax payable plus change in deferred tax liability minus change in deferred tax asset. Okay, and when the deferred tax asset will increase in value, then the income tax expense will reduce in value, and vice versa. And when income tax expense will reduce in value, then the net income will increase, and when income tax expense will have a higher value, then net income will reduce in value. Okay, so that is about the impact of the deferred tax asset on the company's financial statement. Now we will see how the company handles it. The company handles it like when the analyst is going through the financial statement, it has to, if the deferred tax asset is taking place over past few years or a couple of years, then the analyst role is to see how much of the deferred tax asset is realizable, and the changes in the valuation allowance has to be scrutinized, how much they are economically feasible. Okay, how much economically they are feasible in value. So that is about the deferred tax asset and the valuation allowance. Thank you very much.